Welcome to another episode of FIRSTALK Podcast by IDFC FIRST Private. India's growing economic relevance on the global stage is best represented by its buzzing equity markets. The Indian equities are considered a bright spot even when the world was reeling under economic uncertainties and still continues to enjoy the long-term trust of global investors. So we thought, who better than our today's guest to discuss the Indian equity playbook? I'd like to welcome Sunil Singhania on our show. Welcome, Sunil.
Thank you for having me.
Sunil has attained thought leadership as far as Indian equity investing is concerned. He's one of the most successful fund managers, or rather, as he likes to describe himself, alpha generator of our times. So Sunil, we'll start with a very fundamental principle of equity investing. Markets are the slaves of earnings, very famous quote. This quote seems to be true for equity investing anywhere in the world, maybe except for India, right? Of a period from 2016 to 2019, when let's say the Sensex gave a return of about 80% in that 3-year period. But the earnings for the Sensex companies in the same period of 2016 to 19 was just 13%, right? And if the market outlook, the returns of 80% represented a good market outlook and earnings was expected to follow, but there was a 3-year drought on earnings. And any equity investor, who's following the fundamental principles of investing would be very puzzled at why that did not happen, right?
So, frankly, we follow the traditional philosophy of investing, which is companies which make profit and where earnings are there and earnings growth is visible. So completely agree with the phrase that ultimately market prices are slaves of earnings. Having said that, markets are never linear. So you give the example of 16 to 19 where earnings grew much lower than the market prices, but there would be phases where markets would have not grown despite earnings having grown. Yeah. But ultimately they equalize. So if you see the last 20 years of Sensex, for example, or Nifty, the markets would have given you 14-15% CAGR returns. The earnings would have also grown more or less in that line. Having said that, what is market price? Market price is a function of EPS into P. EPS is the earnings. P is the perception. Perceptions will never be the same. Perceptions can be great and perceptions can be negative. And I think that determines the market prices more than maybe the earnings. So I think the market goes through this cycle of undervaluation and overvaluation, and therefore this short-term phenomena of saying that markets have gone up much higher than the earnings and vice versa does not hold true. So even if you see the recent trend in the market, markets technically have corrected 10-12% from the top because earnings growth has slowed down significantly in September. So from a trend of 14-15% earnings growth, we had a 3% earnings growth. And therefore the PE multiple has corrected.
I mean, these are some very fundamental basic principles. How does the investor go through navigating if you follow earnings and if earnings are looking muted, but the market rewards with a significant price growth, like in the example that I gave you, and a waiting period of 3 years for earnings to happen. And obviously 2019 we saw some bit of correction and the NBFC crisis happened, IL&FS and all of that. So that also led to correction. But the moot point is that how does the investor really navigate through these times, and how does he know that this is the right time for the price to start dictating?
That's the toughest thing for any investor, including professional investors like us. You can never be sure of what is the price which is the top and what is the price which is the bottom. Stocks which are expensive can become more expensive. Stocks which are cheap can become cheaper in the interim. But as I said, if your horizon is 3-5 years, they will normalize. The other thing is every investor should realize their own strengths. So there will be some investors who would be good at buying stocks at fair value and holding on to it for a long time.
Yeah.
There might be some investors who are looking only for growth without earnings. And if they are right in their sort of narrative sectors, like what has happened with railways and defense and, recently data centers and AI and all those things, these are narrative sectors. They move for 2-3 years like crazy. Investors don't care about earnings. So those are different set of investors. So I think as an investor, one has to realize what you know and what works for you. The other thing is when we look at earnings and when you look at the PE multiples, it's a combination of the entire market. It is possible that one or two segments are crazily expensive, which skews the multiples of the
even in the recent
index.
market
Even the recent
correction,
year,
you would see that while it looks like the market is corrected, but there are pockets that are still looking.
So I think,
in fact, there are segments, sectors that have actually gotten foreign. While we see 75,000 crores
Very true.
moving out of India,
Very true.
but there are sectors that have actually
Have
got
got
money
inflows.
in, right? So yeah, you're right.
Because it's possible that before that, earnings growth must have been higher and the prices might not have moved. So that is a catch-up which has happened. Or as you rightly said, because the price move was so strong without earnings growth, 19 and 20, you had a big fall.
So basically a bottom-up approach in terms of identifying.
Yeah.
So, and we all started, all of us, believing very strongly that 2024 is going to be the year of large caps because the valuations were fairly attractive. Small caps had run up a lot, and it looked like fundamentally the right thing to believe in and right thing to kind of go out and tell the investors. But when we look at 2024 in hindsight, large cap, let's say Nifty, ended the year at
10%,
a 10% return, whereas a small cap still ended the year at 21% return, right? Despite beginning the calendar year at very high valuations. But it does put an element of doubt in the investor's head in terms of how does he look at valuations, right? While a growth investor sticks through, but a value seeker.
So I would agree with you. Even we had that same view that 24, it's a time to have a more balanced allocation rather than just going whole hog into the mid and small cap.
Yeah.
But see, you also have to understand the dynamics. Mid and small cap typically get invested by local institutions and local HNIs and retail. The foreign money predominantly comes in the large cap
space. Correct.
So in 24, you had an outflow of foreign money, and therefore there was pressure on large caps because they were selling the large caps.
Correct.
And there was massive inflow in the domestic institutions as well as from HNIs and retail, and therefore there was
and the
more
outflow
interest.
From large cap was not necessarily due to valuation reasons alone, right? There
That
were
was more
other
a country sort of a call the foreign investors might have taken.
Correct.
So, from large caps you had an exit, and for the mid and small cap you had a huge flow. The other thing is, come January, that 10% higher return, I think 60-70% of that has already been given. So, if you just expanded or extended it by another month, that skewness has come down quite significantly. So, as we speak, it is logical to say that large caps still have some more comfort compared to mid and small cap on an overall basis.
That applies to, I think, the entire market, but
but large caps are
relevant
predominantly, profit-making, established businesses, large
Stable.
companies. So, you don't have that kind of a skewness, which you would find in maybe a small cap.
Yeah. Another interesting data point that I picked, and I thought, I'll get your perspective on it. Who owns Indian equities? Okay, if you were to just put out a chart on who practically owns Indian equities, 50% of Indian equities, the listed Indian equity space, is held by the promoters. Okay, so the remaining 10% is held by the domestic institutions like mutual funds, and people like you. 18% is FIIs. Okay, again, FIIs largely large cap, but if you would just put the entire market cap, 18%, and just about 15% is retail investors, right? Individuals, HNIs or retail individuals basically. And this is the entire listed space. But if you were to just come down the chain, okay, but companies beyond the top 500 listed companies, as loosely called micro caps, there the retail investor, the individual investor, is 1/3, right? 32-33% of holding is the retail investor. Now, the mystery around this for me, for someone like me, is that there is very little analyst coverage, right? I mean, how typically a retail, an individual investor, or even an institutional investor is driven towards investing in a stock is through analyst coverage, research reports, and what the analyst feels and what the fundamentals of the companies look like, and which is what is brought out by the analyst. There is very little analyst coverage in the microcap space. And despite that, this space has exploded in the last 2 years, right? Practically, the 500th company before the recent correction was close to 9,000 to 10,000 crore of market cap, right? So anything which is 7,000-8,000 crore, was no longer even a small cap. It just moved into the micro cap category as you call it, right? So who are these people investing there, and what is the source of the money flowing into that segment?
It's very logical. Now, for a large institution, whether it's a foreign institution or a domestic institution, unless they are able to get meaningful positions in value terms, why would they break their heads in investing? So, if you are a $10 billion fund, and if you can invest only $1 million in a company, you will not even bother about it, even if you are very, I would say, convinced about the fundamentals of it. So that is one thing. The same goes with the broking side. Why would the research guys in the broking company do research on companies where they are not going to make any revenue out of? So even if you pick up a good stock, and if you can't buy in decent quantities for your clients, the institutional clients, why would you even break your
So
head?
not having analyst coverage is
It's
very
fine.
logical.
In fact, that's an advantage.
Absolutely.
The other thing is, we have 10 crore investors in India, of all sizes. And this concept of family office, professional HNIs investing, we are very unique in India. You don't have this kind of ecosystem in too many countries in the world, including developed countries, where investors are themselves researching and investing. And I think that is also good in a sense, because these companies, which are smaller in size, are also able to raise capital for growth. So I think India is a country which is comprising of millions and millions of small and mid-sized entrepreneurs. And that is what makes our economy. And therefore, it is our duty to always tell investors, particularly the retail investors, that if you're looking at creating wealth, use mutual funds, who would be in a better position to analyze a company, hopefully, than they themselves banking on tips. So unless you are capable and you have the ecosystem of researching a company and buying on fundamental basis, you are ultimately going to get stuck.
But I think the same investor who's going for a small micro cap kind of an investment finds mutual fund very boring, right? Because it's going to give stable.
Either you can create wealth or you can have thrill. You can't have both. So you have to decide. If you want to have thrill, then do it.
This is basically thrill investing, right? Okay, India apparently has the highest number of listed companies in the world, right? So we may not be the largest economy, but we have the highest number of listed companies, and we have a thriving IPO market as well, right? Where new companies are getting listed. But in the last few years, again, when you look at the valuations of some of these companies that get listed, and IPOs are across, they can be classified as large, mid, small, even micro cap, don't really align with the fundamentals or the ratios, the financial ratios, the numbers that these companies put out, right? But despite that, there is a lot of euphoria whenever there is an IPO. Some IPOs are crazy numbers. So how does an investor should, ideally look at IPO opportunity as far as investments is concerned?
So, I'll put it in a very simplistic manner. One is, everyone likes new things. You want something new in life, and it goes for investing also. Second is, when something new comes in, you don't have a history, either good or bad. And that is the case for IPOs. So if there are existing listed companies, and if I tell you, because this is a great company, you will remember something negative. Nahi, arey, isme to ye lafda ho gaya. But when an IPO comes in, you have no history. So there is no negative sort of baggage to it.
Fundamentals take backseat.
Third is, whenever someone comes to sell you anything, they will always give you great stories. Right? No guy who's coming out with an IPO is going to say that mera 2-3 saal kharab hone wala hai. They'll say, we are doing phenomenally well, and we are going to double and triple, and because you don't have any way of knowing the past, you give the benefit of doubt. Fourth is recency bias. So most IPOs have opened with a pop. So you believe that every IPO will open with a pop. So that greed of making quick, short-term money is always there. And I think that is what is happening. My personal view is that 70-80% of the IPOs are not worth investing. Maybe not because they are bad fundamentals, but they are excessively overpriced, building in growth rates which will never be achieved. And my view is that in the next 6-8 months, you'll have at least 75% of all companies which came out of an IPO trading below the IPO price. And I think that is where, investors have to be very, very cautious.
I'm sure sitting on the sidelines, you do evaluate each and every IPO that comes along, right? So you would have observed a lot of scenarios like the one that you mentioned where
Yeah, so
excessive
there are good
valuation,
companies and good IPOs coming in also.
yeah.
But a lot of them are significantly overpriced. Significantly.
So a lot of money flowing into India in the last few years. 2024, we started seeing the flight of money outside of India. Okay, and as we speak, we've seen recently 75,000 crores just move out of Indian equities. Right now, rupee depreciation is considered one of the key reasons that how the FIs really determine whether they move money out of India or not, because they see rupee as very weak at this point in time. Do you think that weak rupee is going to, from a near-term possibility, is going to really be a big deterrent for FI money to come into India?
So for any global investors, obviously currency is very important.
Yeah.
And I think what has happened last 3-4 months is the scenario, particularly in the US, has played exactly opposite of what was envisaged.
Yeah.
So when the interest rate cut happened by Fed, everyone thought that now we are going to have a lower interest rate regime. But the reverse happened. The 10-year yields from 3.7 became 4.7. Trump got re-elected and the narrative was tariffs on every country in the world. And I think that also sort of brought in more sort of a view that US dollar will only strengthen from here.
Yeah.
So I think it's not rupee which has depreciated, it is the US dollar which has strengthened against all major currencies. In fact, if you take out the US dollar, Indian rupee has appreciated against all major currencies.
Okay.
Whether you take British pound or euro or Chinese yuan or
So
yen.
it's basically the dollar effect.
Dollar which has strengthened.
Yeah.
And I think it is obviously because of what has happened. Now if you look at rupee, yes, rupee has depreciated recently by 3.5%. But that's a scenario where the world has been so volatile. You had yen move up and down 10% in a year. You had the narrative of Trump and what was happening in the US in terms of interest rate movement and so on and so forth. And you also had massive selling from foreigners.
Yeah.
Despite that, rupee has been one of the most resilient currencies in the world. And I would say the reason is because one, our current account deficit is come down to almost 1.5%, which used to be 4.5%.
Correct.
Macros could not have been better. Our 10-year GSEC yields are now down to 6.6%.
Correct.
In a scenario where globally interest rates are so sticky. Third is our view on oil is maybe $40-50 to the barrel. Because the way Trump is already starting to say pump more oil. The world is becoming more peaceful now, with Hamas and Israel also entering into a ceasefire, Lebanon also having a ceasefire with Israel, and now Trump also saying that he will sort out the Russia and Ukraine issue also. And on the other hand, you have this huge renewable push. So whether it is solar or wind or hydrogen or battery storage and so on and so forth.
Yeah.
So I think that can be the biggest positive for India going forward. So our view is that if the average rupee depreciation was 3.5-4% per annum for the rupee, I think that has come down to 1.5-2%.
So you think rupee will stabilize in the near term?
It's already started to stabilize at around 86.5.
Will that itself lead to some money coming back? Or you think more needs to be
you
done?
need a combination of a lot of things. So one, we needed a correction which has happened.
Yeah.
Second, you need stability in terms of currency movement. I think third, you also need the global risk on to restart. Right now, other than US equities, all other equity markets have been not doing that great. I'm talking about 1-2 years perspective. I think current year 25, every market has been positive. But you need that narrative also. And in India, you need earnings to come back. I think that is the most important thing. So September was very bad. We had like a 2-3% earnings growth. December has been okay. Not bad, not great, but March is a quarter we are banking on earnings.
You think
again.
Poor performance on earnings is peaked out?
I think so. So we need a massive spend by the government to kickstart the cycle, and then the private sector will come back, and hopefully consumption will also come back. RBI has already pumped in another liquidity dose of 1.5 lakh crore, which is great. And hopefully if the government increases the spend, you'll have a multiplier effect coming in.
Yeah. So dollar stabilizing, earnings coming back, of course, and valuations having corrected reasonably.
So we had a time correction. So 9 months, the index has gone nowhere. and you also had an actual correction from the peak
Yeah.
of 10-12%.
So good time to move back to equities.
So if you ask me any day in the last 25 years, I would have said that it's a good time to invest in equities. So, because ultimately wealth has been created by equity.
But let's just say better than when
always, I
Nifty
think
was at peak
always
of
if you're getting
26,000,
anything 10-20% cheaper, it's always better.
It's always a great buy. I'm sure not everything is great for India as far as Trump coming back is concerned, but what are the pockets where it is great news for India? And where do you think there is concern and we need to really step up because of the change of guard in the White House?
So as I said, the narrative from Trump changes very frequently. Some days you feel that he is the best friend of India, and some days, the narrative is not exactly very friendly. But if you go by his past term, I think very clearly on H1B side he has a view, and I don't think that view has changed. So maybe that narrative at least of anti workers coming from overseas and taking jobs from US and all will be there. Though even last time nothing major happened, but that would be a narrative.
But how big an impact is that? I don't really think that is...
So the US companies also can't do away with it completely, right? So, it's not that you say that no more foreign workers, then who's going to work?
Yeah. So in the first stint, that was more of a narrative.
See, a lot of things move in the market because of what is said,
what is being
rather than what will be the impact of it.
True.
Like this Chinese AI thing, whether they will have an effect or not doesn't matter, but one day Nvidia fell by 10-12%. So markets react in the same direction at the same time because everyone is connected. But coming to the other thing, I think Trump is very clear that any country which has a positive trade balance vis-a-vis US needs to be given a lesson. So the biggest weapon he has is obviously tariffs. So even before the elections, he mentioned about huge tariffs in China. Now, after he has taken up oath, he's not even mentioned China once. Then he said that 25% tariffs on Mexico and Canada starting from Feb 1, but nothing has moved. Feb 1, whatever happens. Now, the thing is that even India needs to do something to have a fair play. So I think there will be always this hot, cold thing. But at the margin, I think the trade surplus of India compared to a lot of other countries is very negligible. So
with the US.
With the US. So I think at the margin it will benefit India. The other thing, if Trump continues with this pump more oil, and if oil really falls to $50-$60, I think that can be the biggest positive which can happen to India. Because suddenly our current account deficit will be non-existent. As you rightly said, the rupee will become maybe stable. I don't see it appreciating because we can't afford an appreciating rupee, but it will be more stable. Companies' profitability will increase because energy as a percentage of their cost of production would reduce quite significantly. So I think at the margin, things are pretty okay. Hopefully our Prime Minister in Asia has a good repo.
So you think a little bit of positive bias for India?
Yeah, 100%. No doubt about it.
Great. So coming back from Trump to back home to India, another emerging trend, Sunil, is the private equity space, the unlisted space, right? Or if I were to ask you this about 6-7 years back, this wouldn't have been really a very relevant play. But today, as we know that number of equity investors have multiplied manyfold, seeking newer opportunities, and that's why this interest in the micro cap space. But this interest is now extending to the unlisted private equity space, right? And that there, obviously, the lack of information or the lack of data on the fundamentals, on the financials of those companies is even larger because they are not listed and there is no regulatory obligation to kind of disclose as much as a listed company does, right? But the interest, nevertheless, is very high, and I'm sure you can sense it too, that everybody who has a large share of money to invest wants to kind of have a little bit of private equity pie there. So how is this trend, according to you, panning out? Is it a fad for the time being, or is it something that will really evolve into?
There's so much interest in privates because one, the recent past experience has been great. Because these companies go for an IPO at a higher price than what they would have sold in the private market. And as we all know, IPOs have had a big pop. And particularly 3-4 of these IPOs have been phenomenal wealth creators.
Correct.
And therefore everyone believes that what they are investing is going to be similar. So that near-term performance is leading to massive greed. Second is every HNI has created a family office, which is great. But these family offices don't have a long history. There are 1 or 2 people who are managing the wealth. And recent history has been great because irrespective of where you invested, you made money.
It's great for everybody, actually.
If you were a superstar, you made great money. Even made mistakes, you made money. So everyone believes that they have arrived in life in terms of their investment capabilities. Third is the FOMO factor. How do investment banks sell you these stocks? They will come and say, this guy is buying, this guy is buying, this guy is buying. So you feel that you are going to be left out. And a lot of your decisions are based on FOMO, and that is also happening. A lot of these companies are going to be big pain in the portfolios because the ability to do research from a lot of these family offices is very limited. And when an institution invests in a private company, they have a shareholder agreement, they have a proper due diligence, legal, financial, and so on and so forth, which these guys who are investing 5, 10, 20 crores will not have.
Will not have, yeah.
So I think that is a pitfall. On the positive side, there's a huge opportunity. Absolutely, there is no doubt about it. So if you see the private equity ecosystem, there are global players, large global players who are active in Indian private equity, and they've done reasonably well. Most of their LPs or almost all their LPs are foreigners. So the domestic Indian investor has never had an opportunity to invest in private equity in a structured or a formal sort of a structure. And I think that is where the opportunity, and that is where we also launched our first private equity fund 6 months back, Abakkus 428 Opportunities Fund, where we raised 2,400 crores. Predominantly we invest in mid to late stage private. As I said, huge opportunity, but the effort you have to do in the private space is very high. There is no exit. In the listed space, if you make a mistake, you will get out maybe 10, 20, 30% lower.
Do investors really understand that there could be no exit for a longer period of time?
Investors understand everything, but greed is always paramount. And you always tend to be optimistic, which you should be. If you're investing in equity, you should feel that tomorrow is going to be better than today. Otherwise, you should not be investing. But what risk you are taking, that the investor has to understand. So the return and the risk you have to combine. Plus, it's a long gestation product.
So how much of this money, according to you, is coming through formalized vehicles like some of the fundraise that you do, and how much of it is coming through informal?
Most of it is direct.
Most of it
is
which is what the worry is.
The family offices,
So it's a great opportunity according to you, but it's better to be exposing.
You can't have a big portion of your investable net worth in private.
And do it through more formal vehicles where
or build a capability.
Build a capability is
very difficult.
Bit of a long shot.
Very difficult.
And that's not something great. And see, while we are talking about the equity playbook, Sunil, one asset class that everybody was very excited, and I was very excited maybe 10, 12 years back when it got introduced, cryptocurrency, right? And you said there are 10 crore equity investors. I read somewhere, I don't know how factually correct it is, but there are about 17 crore cryptocurrency investors in India.
I don't think that's the right figure.
Various platforms put together
I don't
and all
think
of that.
so.
May not be active.
I have also read it, but I think it's...
Yeah, so...
It's over-exaggerated by a multiple of 100.
My question is that, how would you have on a product like cryptocurrency where there is so much of lack of transparency, to say so, and lack of information, and for the fact that for the last 10, 12 years, it has remained an emerging asset class, right? You can't be an emerging asset class for 10 years, right? Either you should have emerged, or you should have just kind of, out of the way, but it still stays there. Is it a serious investment vehicle? Because a lot of people dabble into it. A lot of first-time investors, I'm told, dabble into cryptocurrencies. And is it again the thrill factor that plays out here, or you think there is a genuine future that cryptocurrencies have? What's your view?
So, I travel a lot, and even I was intrigued by what this cryptocurrency is even 8-10 years back. And in fact, I did a short course also to understand it.
Really?
I understood blockchain. I was not able to understand cryptocurrency.
No, despite frankly.
And my view is that something which you don't understand, you just leave it alone.
Yeah.
But cryptocurrency, I don't think it's an asset class. It's a trading instrument. There is a shortage, and now a lot of these endowment funds have also started allocating some percentage to this cryptocurrencies, and maybe there is more demand than supply, and therefore the price is where it is. But as an investor who likes to understand what is the underlying, so when you are investing in equities, you are investing in companies which you can see, which you can talk to. When you are investing in gold, you know the underlying. When you're investing in fixed income, you know that there is a bank or a corporate who is guaranteeing it.
Yeah.
Behind cryptocurrency, you don't know anything.
Yeah.
So whether the price should be $10,000 or $20,000 or $90,000, there is no way of assessing it. So it's all based on demand and supply.
Okay.
As far as so many people are interested, I think it's a trading instrument. You trade in anything. If there's volatility, people will be interested.
Great. So, Sunil, you've transitioned from being a fund manager for a very long time to now an investment entrepreneur yourself when you set up Abakkus a few years back. So I would want to understand what motivated you to kind of take this entrepreneurial step. And more importantly, for somebody who's had a corporate career as a fund manager into investments for a long time, what are the skill sets required for you to transition from what you're doing? Because you continue to do what you're doing professionally, same thing, but now in the avatar of a entrepreneur.
The first thing, what was the reason? So I think if you look at, say, US, you have the retail funds like Vanguard and the BlackRocks,
Yeah.
where the retail money goes in, and you have these family offices and sophisticated investors who want boutique asset managers. I think in India, when I was contemplating turning an entrepreneur, we only had the mutual
This was in
funds.
2013.
17, I started talking about it, and 18, I set up Abakkus.
Yeah, okay.
So there was a space of niche, professionally run asset management companies which would be able to attract, obviously, investors. So that was a motivation. Second is, the good thing is when I joined Reliance in 2003, so I was there for 15 years, we were the smallest asset manager, 35th out of 35 mutual fund.
When you started off.
The total asset was 50 crores in equity. And, our corporate guys were so big, they didn't even bother about this business. They said that as long as you don't ask for capital, you do whatever you want to do. So actually we used to run Reliance Mutual Fund like entrepreneurs. I think that helped. So from being the smallest, we became the largest like in 6-7 years. And I think that thing helped a lot. The motivation, as I said, to start was looking at what has happened in the US in terms of some professional investors.
You could foresee that this is the space that India is going to really
But there's a big difference. So when you're working in a large corporate setup, you get your salary on the first day. You get to office, you have a superb cabin, you have all the ecosystem. You order, you get tea, whatever you want. You have a secretary who manages everything. And when you turn entrepreneur, instead of getting money on the first, you have to start spending on the first because, it takes time for you to build up. So there is a little bit of, I would say, change of mindset which is needed. But I think the good thing, as I said, is we were actually quasi-entrepreneurs. So the only decision which we took, or which I took when I set up Abakkus, was that I calculated the 1 year gross expense, that this is the maximum expense we would do without any revenue. I funded it on the first day, so that the pain of funding it every now and then does not happen. I think that was good. The rest is, I think the good thing is that the connect was there, the investors were there. Luckily for us, we did pretty well despite COVID and so many setbacks. And now, see, the growth is unlimited if you do well. So we are already 36,000 crores.
Wow.
So in 5 years, we have grown to 36,000. And now we are adding assets. So we have already added this private equity. Hopefully we'll add other assets. We hire 130 people. That is the most, I would say, comforting or the most happiest thing because, 130 families are getting gainfully employed. We have a happy family, small team, but good. So I think all those motivations keep on going.
So looking ahead, the Indian equity landscape looks from a long-term point of view very, very bright, right? So How are you looking at this opportunity from not just from Abakkus standpoint, but overall, how does this opportunity look?
So I think 2-3 things. One is India is a growing economy.
Yeah.
So in a growing economy, growing assets like equities will always do well. But having said that, last 3-4 years returns have been unreal. This 25, 30, 35% CAGR returns are unreal returns, and we should thank whoever, that for this bounty. I don't think these returns are sustainable at all. Our thing is that next 3 to 5 years, maybe low to mid-teen returns. And after 5 years, maybe more like very low double-digit returns is what you should expect. Because when you reach a base of $6-7 trillion in economy, it's very difficult to grow at 6-7% real and 10% nominal. It's
Correct.
impossible.
Yeah.
So your growth rates will come down, corporate profit rate growth rates will come down. And I think we started with the line that, they are ultimately slaves of earnings. So they will catch up. But it's a growing asset. I think India still has a long, long way to go. With some basic checks and balances, I think an investor can make the highest return across asset classes in equities.
So the earlier goal of 5 trillion economy by 2025, was it?
I think that we will achieve, maybe a little bit here and there because dollar has appreciated by 3-4%.
Yeah. So by 2027?
26 we should be there.
Now, before we sign off, we have a few more questions which we will kind of finish off very quickly. So we call it the rapid fire round. Right? One sector, Sunil, that you're most bullish on right now, and why, if there is any specific reason?
Financials. I think there's after I would say 1.5 years of liquidity squeeze, the central bank is releasing liquidity. Valuations, this is one sector where valuations are lower than the 10-year average. And decent, I would say, franchisees. So financials will be.
Great. The best book you've ever read on investing, and why do you think it's the best book?
Best book, I would say Reminiscences of a Stock Operator. I love that book. I read it. I've read it 3-4 times. I like to read autobiographies. So I've just finished Elon Musk autobiography. It was not great, but okay. And the reason is, for 500 rupees, you are basically able to learn about the 25-30 year of experience of a very famous personality. I think I always recommend reading biographies because even if you take 2 or 3 things out of it, I think it's worth it.
Yeah, biographies are my favorite genre of books as well. Who is your mentor, role model in the investing world? I'm sure you would have looked up to somebody who's...
I think it will not be fair to name any particular investors, but I've been blessed because I've had good friends, good colleagues, good mentors. And the thing is that, if you see the Indian equity ecosystem, there are maybe 30, 40, 50 of us who have survived for like 25, 30 years. And it's a good close family, there's no competitive intensity to it, So I've worked with Madhu for a long time. I think great memories. Yeah. But other mentors have also been all there, when we need.
One common mistake all equity investors typically make, and you think one should avoid?
Greed. I think that is the biggest mistake. And I would say calculating your net worth compared to some others. So this relativity is the bane.
The fundamental reason for why you're investing.
If you look at, I'm a big Bollywood fan, and there's this movie 3 Idiots, and the exam day, the results come, and Amir Khan's name is not there, so his 2 friends get very sad. And when Amir Khan's name comes as being the topper, they get more sad. तो बोले दोस्त फेल होता है तो दुख होता है, फर्स्ट आता तो ज़्यादा दुख होता है. तो I think in this relativity, you end up taking extraordinary risk for your greed, and I think that is the biggest major reason for anyone's downfall.
For 2025, your pick between equities, gold, and real estate.
So I think you shake me at any day, I think it's going to be equities. Because it's a growing asset, as I said.
Your personal portfolio is all equities, or you really have diversification?
No, I have some fixed income. Yeah. But if you look at the value of my company and the other assets which I own, I would say equity would be well above 90%.
Well above 90%. If not an investment manager, what do you think you would have been?
I don't know. Yeah, I started off as an accountant, practicing chartered accountant. But equities I have loved since my college days. So
it's more of passion than profession.
And it's worked out well. So see, if I would have joined equity and it would have not worked out, then maybe I would have thought about something else. So a lot of times, in hindsight, we think that this guy is great and so on and so forth. A lot of luck is also involved.
Yeah,
And we
sure.
have to every day pray to God and our elders for the blessings they have given us.
Yeah.
Because I would say there are lakhs of individuals in India who would be more intelligent by a mile. But maybe luck has favored.
And the
We have
risk-taking
been
ability to
in the right
be an-
place, right time, you know.
One Indian company you admire the most and why?
See, again, very difficult.
You may or may not have
But-
invested in it, but you just...
No, I don't want to name, but I would say that the quality of entrepreneurs has massively improved in India over the last 10, 20 years. And I have this philosophy, you know, earlier Indians used to go abroad with the perspective of studying there and settling there.
And staying there.
You know, I think that's completely changed. Now the kids are going abroad.
Studying and coming
They
back.
want to come back, and they
Yeah.
come back with knowledge, with technology, and I think that is going to be a game changer for India for the next 10,
That's a
15
trend,
years.
very.
So I think we are seeing that in a lot of these entrepreneurs.
The first thing or the most important thing you look at in any potential investment that you make in equities.
Earnings, discipline as far as capital allocation is concerned, and growth.
Your favorite financial ratio when you evaluate? I'm sure you can't just look at one, but if you were to just look at the most important one.
I am value conscious, so I would say ROE measured with P.
ROE measure. Okay. So one habit or one discipline that you feel has contributed majorly to your success.
Reading more than 1,000 balance sheets in a year.
Yeah. You just
So I started reading balance sheets when I was in college. And when I joined equity markets full time, the good thing was no one used to read balance sheets.
yeah.
So you are, alone who was doing that.
1,000 balance sheets a year.
Yeah, even now I try to do it. And I think that because it's been a habit for so long, almost all relevant companies, the basic numbers almost by heart.
Does that come from your chartered accountant background?
It helps because you're able to understand, but it's not only that, you have to develop that thing of reading it. So I would say balance sheets might help you with stock picking to a certain extent, but it prevents you from making big
Making
mistakes.
mistakes.
And it's like a pot. If there's a hole in it, kitna bhi pani dalo, wo drain ho jayega.
Yeah.
So portfolio is like that.
Yeah.
You have many good companies, but if you also have companies which are going to make losses, that pot will never be filled.
Like I always believe in investing that, it's great to know where to invest, but it's more important to know where not to invest. Invest, right?
Yeah.
Great, phenomenal. Sunil, great
you.
talking to you. As always, we could have continued, I think, for a longer time, but in the interest of time, I think that's all that we have for today.
Thanks a lot.
So thank you, Sunil, for taking time out for this amazing conversation, as always. So this brings us to the end of a wonderful conversation with Sunil Singhania. Hope you enjoyed listening to it as much as I enjoyed talking to him. Stay tuned for our next episode of First Talk by IDFC First Private. Until next time.